When a central bank starts changing the label before it changes the policy, I pay attention. That is where the real story usually begins. Not at the press conference, not in the headline, not when the television finally decides something is important enough to dramatize. The real story begins when the institution knows the truth is too ugly to describe in plain language, so it reaches for a softer phrase. That is what should stop you cold. Because once a monetary authority starts renaming the same old act, the act matters more than the language. And right now that act is very simple. New money is being created to keep the debt machine breathing. Most people think that is a gold story. It is bigger than that. It is a measuring stick story. When the thing doing the measuring starts losing discipline, every asset priced in that thing has to be reread. That is why this matters. Not because gold is shiny, not because people are emotional, not because a chart went vertical and somebody on the internet decided to call it destiny. It matters because when the Federal Reserve starts walking back toward debt monetization while pretending it is doing something more technical, more careful, more respectable, the architecture underneath the entire dollar system begins to shift. And when that architecture shifts, gold is not merely another asset going up. Gold is the mirror telling you what the measuring stick is becoming. If you do not understand that, you will keep reading the gold market like a tourist and the monetary system like a child. You will see price. You will miss mechanism. You will hear words. You will miss intent. You will study candles. You will miss compulsion. And in markets, compulsion is where the biggest moves are born. So let me give you the mother line first, because everything else hangs from it. When a debt system gets large enough, the central bank eventually stops choosing and starts obeying the arithmetic. That is the line. That is what you need to hear, not later. Now, because once the arithmetic is in charge, credibility becomes the asset at risk. And when credibility becomes the asset at risk, gold stops being a side trade and starts becoming monetary insurance again. I have watched investors make the same mistake for decades. They think policy is whatever a central bank says it is. No policy is what the balance sheet is being forced to do. Words are public relations. Balance sheet behavior is truth. If the institution says tightening and the plumbing says liquidity, if the institution says discipline and the purchases say accommodation, if the institution says temporary technical measure and the mechanism says new money buying government debt, then I believe the mechanism always. Because in the end, a financial system is not moved by adjectives, it is moved by flows. And right now the flow that matters is this. The Fed is creating reserves and directing them into government debt under a name designed to make the public feel less alarmed. That is not a footnote. That is a tell. I call the first mechanism the cover word trap. The cover word trap is what happens when an institution uses a gentler phrase to smuggle a harsher reality past public attention. Definition is simple. The action stays dangerous. The wording gets polite. That is how bureaucracies confess without confessing. If a central bank creates money and uses it to buy government debt, I do not care whether the memo calls it quantitative easing, reserve management, market functioning, support temporary liquidity operations, or some new phrase invented by a committee that wants to avoid frightening donors, politicians, pensioners, and television anchors. The mechanism is the thing. Money creation aimed at debt absorption is money creation aimed at debt absorption. Dress it up if you like. The costume does not change the act. Ordinary investors get fooled here because they have been trained to react to labels. They hear that it is not formally QE and they relax. They hear that it is reserve management and they assume it must be some narrow technical procedure with no wider implication. That is how people stay asleep while the foundation moves under the house. I do not care what they call it. I care about what it does. And what it does is this. It injects new purchasing power into a system drowning in government obligations. It supports the market that the government depends on for survival. It suppresses the immediate consequences of excess debt by redirecting newly created money into debt that the market is less eager to absorb at painless yields. That is the truth. If you understand that, the fog clears. The first advantage in investing is not intelligence. It is refusing to be managed by euphemism. Now let us move to the second mechanism. I call it the debt gravity engine. The debt gravity engine is the point at which the existing pile of debt becomes so heavy that the system's policy choices narrow from many to very few. Again, definition is simple. When refinancing needs become enormous, interest costs become punishing, and the natural buyer base weakens, the central bank is not managing an economy anymore. It is managing a debt roll. That is a different game. And once you are managing a debt roll, your real freedom is already gone. Most people hear national debt numbers the way they hear weather reports. Large, abstract, impersonal. They have no emotional reaction because the scale no longer feels human. That is a mistake. In investing, the huge numbers are usually the ones that matter most. If a government has to refinance a gigantic slab of debt in a short window, and rates are no longer near zero, the arithmetic gets ugly fast. Interest is not theory. Interest is an invoice. $1 trillion in annual interest is not a slogan. It is a transfer. Money spent not on defense, not on infrastructure, not on schools, not on productivity, but on servicing what has already been promised. That is when debt stops being a background condition and starts becoming the main character. And once it becomes the main character, the Fed is no longer free to play philosopher. It has to play mechanic. That is the debt gravity engine. It pulls every nice-sounding principle down toward what is politically and financially survivable. This is where people still deceive themselves. They imagine the Fed choosing between discipline and ease. That is not the real choice. The real choice is between absorbing strain through the currency or absorbing strain through the system's collateral market. When you put it that way, the path becomes obvious. A bond market the government depends on cannot be allowed to fail cleanly. Not in a heavily indebted country, not at this scale, not when refinancing windows are measured in trillions, and once you know that, you know something else. If private buyers and foreign official buyers are less enthusiastic than they were, somebody still has to stand in the gap. Markets hate gaps. Debt markets hate them most. That somebody, sooner or later, is the central bank. Again, not because the central bankers are evil, not because they are stupid, because arithmetic outranks rhetoric. That is the point people keep missing. I am not interested in central bank morality tales. I am interested in constraints. Constraints are what make policy real. Now we reach the third mechanism. I call it the forced Fed. This one matters more than any speech you will hear for the next year. The forced Fed is the moment the market realizes the central bank is not printing because it wants stimulus. It is printing because not printing would reveal the system cannot fund itself smoothly at the advertised price. That distinction is everything. A central bank that chooses accommodation can pretend it still has optionality. A central bank that is forced into accommodation by debt rollover pressure, banking system fragility, or collateral stress is telling you something much darker. It is telling you control is already thinning. This is where gold changes character in the first phase of a monetary problem. Gold rises because sophisticated actors are repositioning. In the second phase, gold rises because the crowd starts realizing the repositioning was rational. That difference matters. Phase 1 is smart money reading the direction. Phase 2 is broader money realizing the central bank is cornered. When that realization spreads, gold is no longer treated like a niche view. It becomes a necessity to people who were late. And late money is emotional money. Emotional money pays the highest prices. That is how these sequences work. I have seen this pattern over and over. People imagine that when the central bank is in trouble, the move will be announced with trumpets. No, first it leaks into the system as contradiction. Officials say one thing, operations do another. Policy goals sound responsible. The math underneath makes them impossible to keep simultaneously. That is the clue. If somebody tells you he wants lower rates and a smaller balance sheet, while the system needs trillions refinanced into a thinner bid and still requires quiet liquidity support, do not admire the slogan. Interrogate the contradiction, because two beautiful objectives can still be mutually impossible. And in finance, mutually impossible objectives always produce a hidden sacrifice. Usually the sacrifice is the currency's future purchasing power. People hate hearing that because it sounds dramatic. It is not dramatic, it is mechanical. If the bond market cannot absorb enough supply at comfortable yields, either yields rise, the buyer base expands, or the central bank fills the gap. Those are the doors. If rising yields threaten the system and the buyer base is not magically deepening, the forced door is obvious. That is the forced Fed. The institution keeps a respectable face. Underneath, it is already serving the debt machine. Now let me tell you why this links so directly to gold. People keep describing gold as an inflation hedge. That is not wrong. It is incomplete. Gold is not merely a hedge against prices going up. Gold is a hedge against the credibility of the unit in which prices are measured going down. that is bigger. If bread rises 10%, that is one kind of inflation. If the market realizes the steward of the currency is now trapped between debt maintenance and credibility preservation, that is something larger. That is a regime shift in confidence. Gold lives on confidence gaps. Every time the gap between official language and monetary reality widens, gold becomes more relevant. Not because gold is magical, because it sits outside the promises being stretched. That is a profoundly different thing. Now we reach the fourth mechanism. I call it the reserve exodus. The reserve exodus began the moment sovereign actors around the world learned in public that dollar claims could become geopolitical instruments faster than most reserve managers had wanted to admit. That lesson is not theoretical. Once the world saw a major power's foreign reserves frozen, something permanent entered the thinking of every central bank that is not completely sheltered by alliance, dependence, or innocence. The thought was simple. If they can freeze those reserves, then reserve assets inside that architecture are not purely neutral. That thought matters because reserve management is not about romance. It is about survivability. A reserve manager is not asking what asset sounds impressive at a conference. He is asking what survives sanction, political hostility, and monetary abuse. That is why central banks started accumulating gold so aggressively. Not because a chart technician found a breakout, because reserve managers read the world correctly before retail did. That was phase one of this gold move. Quiet, institutional, methodical. No sirens, no mass public interest. Just large, sophisticated actors moving before the crowd understood. The reason, that is how serious moves usually start. People think a bull market begins when everybody is talking about it. No, that is when a bull market gets dangerous. A real bull market begins when the right actors start repositioning while the public is still distracted by other toys. That is what happened in gold. The reserve exodus is central to this whole story because it tells you the gold market did not begin rising on a superstition. It began rising on sovereign distrust. That is one of the deepest and stickiest forms of demand there is. If a central bank concludes that part of its reserve base is politically vulnerable, and gold is one of the few assets without that exact counterparty risk, it is not buying because it wants excitement. It is buying because it wants insulation. Insulation demand is durable demand. That is why the move mattered. And that is why the Fed's behavior matters so much now. Because once the world's reserve managers are already drifting toward gold for strategic reasons, and then the Fed starts revealing through operations that debt arithmetic is beginning to overrule monetary presentation. Two stories merge. Strategic reserve distrust meets domestic monetary compulsion. That merger is where things get serious. Now we arrive at the fifth mechanism. I call it the oil accelerant. This is the force people forget until it is already doing damage. Oil shocks compress time. That is what they do. A monetary problem can stay abstract for years. An oil shock can force it into the bloodstream of the economy quickly. Energy costs move into transport, manufacturing, food, logistics, sentiment, and politics, and they do it fast. That is why oil shocks and gold have such a long history together, not because the relationship is mystical, because oil makes inflation more persistent and makes central bank discipline more expensive. That combination is toxic. If energy prices jump, inflation pressure gets embedded more deeply. At the same time, aggressive tightening becomes harder because growth slows, leverage strains, and indebted systems cannot tolerate the same medicine for long. Now put that into the current situation. A Fed already sliding toward quiet monetization. A debt market that needs constant refinancing. A world already less trusting of reserve neutrality. And then energy stress appears. You now have three layers working together. Structural reserve, diversification. Domestic debt monetization pressure. And an external inflation accelerant. Those are not three unrelated headlines. They are stacked pressure. That is how regimes turn. This is one of the points where ordinary investors usually break. They keep trying to isolate one explanation. Gold is up because of inflation. Gold is up because of war. Gold is up because of rates. Gold is up because the dollar is down. That is the childish way to analyze a monetary metal. Gold does its biggest work when multiple confidence, damaging forces start reinforcing each other. That is what you need to see. The issue is not one variable. The issue is alignment. When reserve distrust, debt arithmetic, and policy compulsion align, you are no longer in an ordinary market story. You are in a monetary transition story. And monetary transition stories do not wait for everybody to feel comfortable. They punish comfort seekers. Now, let me tell you what phase structure looks like, because people need a process, not a slogan. Phase 1 is quiet institutional repositioning. In this phase, central banks, sovereign funds, and more serious pools of capital are moving first. Gold rises, but the public explanation lags. People call it strange. People say they do not understand why it keeps moving. That confusion is normal. It means the move is still early enough that the thesis is not yet socially obvious. Phase 2 begins when the market understands the central bank is not merely choosing easier policy. It is being dragged there by debt math and systemic fragility. That is the phase in which gold stops being a curious outperformer and becomes a visible monetary verdict. This is when broader money starts arriving, not because it became wiser, because the contradiction became too obvious to ignore. Phase 3 is the true endgame risk. Not tomorrow morning, not next week, but the place this road leads if the fiscal system keeps avoiding real reform and the central bank keeps absorbing what the market will not. Phase 3 is when the bond market itself becomes the problem that can no longer be hidden behind language. Higher interest expense leads to more borrowing. More borrowing leads to more issuance. More issuance meets thinner demand. Thinner demand pushes yields. Higher yields worsen interest expense, and the cycle feeds itself. That is when the central bank is no longer smoothing. It is suppressing. And when suppression becomes permanent policy, the currency pays the bill. I do not tell you this to sound cinematic. I tell you because most people do not understand how governments actually resolve debt spirals. They do not repay them honestly in money that retained full value. They devalue the burden through time, inflation, repression, or some mixture of all three. That is the historical pattern, and gold exists right in the center of that pattern because it is one of the few monetary assets that does not depend on an issuer keeping his promises. Now, let me give you another mechanism, because this one is where the smart money is usually found before the crowd wakes up. I call it the minor mismatch. The minor mismatch is what happens when the underlying metal reprices higher, the economics of the miners improve dramatically, and yet public money still has not rotated into the mining shares. That mismatch can get extreme. People forget how mining economics work. If the metal price rises while a large portion of operating costs do not rise as quickly, margins can expand far faster than the top line. That is leverage. Not the dangerous retail kind created by borrowed money, operating leverage. A miner making a thin margin at one gold price can become a cash machine at another. And yet the public often ignores it because the public is always late to the part of the cycle where the fundamentals have improved more than the narrative. That is what makes the minor mismatch interesting. You can have record or near record profitability while public attention is still elsewhere. That is how early major bull moves often feel from the inside, confusing, under-owned, quietly profitable. Not yet celebrated. The crowd is still chasing whatever has a louder story. Technology, artificial intelligence, momentum, anything that flatters them more quickly. Meanwhile, the miner's cash flow improves, institutions start looking harder, and the public still has not shown up. I am not telling anybody to buy a random mining stock because he heard the word margin. Mining has its own risks. Operational mistakes, political risk, geology, management stupidity, cost blowouts, those are real. But the structural point matters. If the metal is repricing for monetary reasons and the mining sector still has not become crowded, that is not a trivial observation. That is one of the ways cycles hide their best asymmetries. Now, I want to make the identity flip explicit. Most investors still think like portfolio decorators. That is a problem. They want a little gold because gold feels prudent. They want a little silver because silver sounds exciting. They want some miners because miners sound levered. That is decorative thinking. I want you to think like an allocator facing a changing monetary architecture. That is a different identity. A decorator asks what looks balanced. An allocator asks what survives policy compulsion. A decorator asks what diversifies nicely on a slide. An allocator asks what sits outside the promise structure when the promise structure is being stretched. A decorator asks whether gold is overbought. An allocator asks whether the measuring stick is being managed by debt arithmetic. Those are radically different minds. If you stay in the first identity, you will forever mishandle. A move like this, you will trim too early because it feels extended. You will mock it because the fundamentals seemed old-fashioned. You will wait for certainty because certainty feels responsible. then you will buy after the market already forced you to understand what you could have understood earlier by reading mechanism instead of mood. That is how retail capital gets punished. Now let me take you deeper into the arithmetic, because this is where the whole structure becomes undeniable. A central bank can survive looking foolish. It cannot survive allowing the sovereign bond market to become disorderly in a heavily indebted system. That is the true hierarchy. People imagine price stability sits at the top. No, in a genuinely indebted monetary system, collateral stability and government financing usually outrank almost everything. Once the pressure is strong enough, this is why central banks keep repeating the same pattern across decades and countries. First they talk tough, then they discover the system is weaker than their speeches, then they stabilize what cannot be allowed to wobble too hard, then they rename the stabilization, then the currency absorbs what the language concealed. Every major student of money should have that sequence memorized, because once you see it once, you see it everywhere. And right now, the United States is not exempt from arithmetic simply because it issues the reserve currency. That privilege buys time. It does not repeal math. In some ways, it makes the eventual adjustment more subtle, because the world gives you more rope, but rope still tightens. If the debt stock is huge, if refinancing is constant, if interest costs are rising, if the central bank is already carrying losses created by paying higher rates against lower yielding assets acquired in a previous rescue regime, then do not tell me this is normal central bank housekeeping. This is stress management. You can call it reserve management if you want. I call it stress management, with a printing press hiding behind office furniture. Now ask what happens when the market fully internalizes that. Not the gold bugs, not the internet personalities, the broad asset allocation crowd, the pension world, the institutions that still think in old categories, the households that still assume bonds are neutral and cash is apolitical, and the currency is simply a measuring tape rather than a policy battlefield. Once they internalize it, the move changes phase, because gold does not need everybody. It just needs enough large pools of capital to recognize that the central bank is no longer operating from preference, but from compulsion. Once enough people know that gold's role changes in their minds, and once the role changes, allocations change. That is how the second leg of a serious bull market usually works. The first leg is driven by the right buyers. The second leg is driven by the realization that the right buyers were right. That realization can be explosive. Now, I am going to say something that will irritate people who love certainty. You do not need a perfect forecast to act intelligently. You need a correct diagnosis of the direction of pressure. People constantly demand exact price targets, exact months, exact bottoms, that is ego dressing itself up as rigor. The job is not to be clairvoyant. The job is to understand the structure well enough that you do not stand in the wrong place while the structure is moving. That is enough. It is more than enough. If the Fed is already moving in the direction of debt absorption by newly created reserves, if the sovereign debt burden is already large enough to make pure discipline economically and politically painful, if the world is already less comfortable storing all of its reserves in politically manageable claims, if oil and geopolitics are adding accelerant, if miners are becoming more profitable before public money has fully arrived, then you do not need a tarot card, you need a process. So here is the process I would use. First, ignore names and study mechanisms. Do not let vocabulary tranquilize you. Ask what the operation actually does. Second, study refinancing pressure. How much debt must roll at what rate? Against what buyer base with what political tolerance for disorder? Third, watch the contradiction between stated policy and necessary policy. Those contradictions are where forced behavior reveals itself. Fourth, monitor reserve behavior globally. When central banks buy aggressively for years, that is not a hobby. It is a message. Listen to it. Fifth, watch the accelerants. Oil trade disruption, geopolitical stress. These compressed timelines. Sixth, separate direct protection from leveraged expression. Gold is the direct monetary insurance. Silver can become more violent later. Miners can offer operating leverage, but with company and execution risk layered on top, do not confuse them. Seventh, decide what role each asset plays before the volatility arrives. If you wait until the stress is obvious, the price you pay will include your own panic. That is always expensive. And now I want to address the most dangerous group of all, the people waiting for confirmation. They think they are being prudent. Usually they are volunteering to buy high. Certainty in markets is usually delivered at punitive prices. By the time everyone agrees the central bank has changed direction, The first easy move is often gone. By the time every commentator says gold makes sense, it has already made sense for quite a while. By the time every retail investor notices the miners, a lot of the operating leverage has already been recognized by somebody else. That is how transition markets work. They reward people who can infer from mechanism. They punish people who require public consensus. Consensus is not safety. Consensus is late. That is one of the most expensive misunderstandings in investing. Now, let me cut straight to the heart of it. What the Fed just did is not important because it guarantees some immediate gold target. It is important because it reveals the direction of institutional surrender. That is the phrase I want you to remember. Institutional surrender. Not surrender in the sense of collapse tomorrow morning. Surrender in the sense that the arithmetic is beginning to dictate behavior more than doctrine is. Once that process begins, it tends not to reverse because someone gave a stern speech. It reverses only through credible fiscal change, real balance sheet repair, or enough pain to reset the system. In other ways, absent that, the printing path keeps reappearing, sometimes loudly, sometimes quietly, always expensively. Gold is not the story. Gold is the verdict. That is how you need to think about it. A rising gold price in this context is not just enthusiasm for metal. It is a market-level judgment on the quality of future restraint in the monetary system. A central bank can dislike that judgment. It cannot fully legislate it away. This is why I do not laugh when gold rises while official rhetoric sounds tough. I ask whether the rhetoric or the balance sheet is lying. Usually one of them is, and the balance sheet rarely lies for long. Now let us talk briefly about silver because people always drag silver into the conversation without understanding its place. Silver is not gold with more excitement. Silver is a different beast. It often behaves like a later stage amplification of the precious metals move because it has both monetary and industrial dimensions, and because its market structure can become more emotional once the crowd enters. That makes it dangerous and potentially very rewarding. In the right phase, silver can move harder than gold. In the wrong phase, silver can punish impatience brutally. So if you own it, know why. If you do not know why, then you are not allocating, you are reaching. And reaching is how investors turn a correct macro view into a bad outcome. The same rule applies to miners, only more so. You do not buy a miner because somebody told you miners are levered to gold. You buy only when you understand that you are adding execution risk, jurisdiction risk, cost risk, and management risk to a monetary thesis. If you do not understand those layers, you do not own leverage. You own vulnerability disguised as leverage. That is not the same thing. Now I want to end with the operating system because every serious move eventually becomes a test of identity. Here is the operating system I would want burned into your mind. When an institution changes labels, ask what it is trying to hide. When debt gets huge, stop pretending policy is free. When the central bank starts doing the opposite of what it spent years describing as responsible, believe the action over the slogan. When sovereign reserve managers buy gold in record size, assume they know something about the architecture, not just the price. When energy shocks appear, prepare for time compression. When direct monetary insurance and leveraged expressions start diverging in public attention, study the divergence instead of chasing noise. When the crowd asks for certainty, remember that certainty is usually sold at premium prices. When you build a portfolio, know which positions are insurance, which are expression, which are optionality, and which are vanity. Remove the vanity. Vanity positions exist to flatter you in good moods and betray you under pressure. Now here is the final test. Do you still think gold is just another asset in a diversified pie chart? Or do you now understand that in a debt-heavy monetary system, gold is one of the few ways to step partly outside the promises being bent? That is the choice. One identity treats gold as decoration. The other treats gold as monetary distance from an issuer being overruled by arithmetic. That is a much harder way to think. It is also much more useful. Because if this is merely a cyclical trade to you, you will exit at the wrong time. If this is a monetary architecture shift to you, you will evaluate it correctly, not emotionally, structurally. And that is the blade I want to leave you with. The Fed did not just do something to gold. The Fed did something to the meaning of the dollar, and gold is one of the first places that meaning gets repriced. Miss that, and you will spend the next phase staring at the screen, confused. See it, and you will understand why the most important move in gold was never about gold alone. It was about what the people running the measuring stick had already started to concede through behavior, long before they were willing to confess it in plain English. That is how monetary systems change. Not all at once. Not with perfect honesty, step by step, phrase by phrase, purchase by purchase. Until one day the crowd realizes the architecture has already shifted, and the price is no longer asking permission to reflect it. When that day comes, do not say nobody told you. The clues were here, in the wording, in the purchases, in the debt math, in the reserve behavior, in the oil shock, in the contradictions. The market has already started reading them. The only question left is whether you will.